Let's welcome on board Sarvjit Singh Sarma, the MD and CEO, and Munish Jain, the ED and CFO at Capital Small Finance Bank, joining in right after their listing. Gentlemen, both of you, thank you so much for joining in. Mr. Singh, if I could start off with you, 523 crores of your total IPO size with the fresh issue of 450 crores. For the interest of our viewers, can you tell us how this is going to impact your CET ratio?
Yeah, the capital that is coming in is growth capital. That will add to our tier 1 capital, and the money will be used for future growth, growing both our top line as well as our bottom line. Otherwise there was no, still the regulatory timeline to raise capital was still there. But it is a pure growth capital that we have, the round that we have done. Yeah.
Right, Mr. Jain, let's talk about your loan book, because an impressive portion of close to 99.8% of the book is under secured lending. How will this shape up? Will your loan book always remain under majorly under secured portion? And how will this support your net interest margin expansion?
If we look into the historic number, so we are 99% plus or secured book. And within this, more than 84% of the book, we have a collateral in the shape of immovable property. So typically a true term secured lender. And if we have a look into this from the product split perspective, we are typically, our loan book is falling into 3 baskets, which we internally call it a MSME, mortgage and agri. Going forward also, we intend to be a middle income group based lender. We intend to be a secure lender and concentrating on these 3 products. Yes, depending upon the geography, our target of out of these 3 products will continue to move. Say one of the geography, depending upon the potential at a geography having a higher potential of mortgage, we'll be putting a stronger paddle on the mortgage in that geography. In the geography having a higher potential for the MSME, we will be putting a higher message on the MSME. So typically, but overall, we will continue to be a secure lender within these 3 product segments we are talking about in a middle income group segment. And if we talk about the NIM expansion, if you look into our business model, we are typically a 5.7 to 6% interest spread entity. From interest spread, the perspective from the interest spread is the difference between our yield on advances and cost of deposit. Within this interest spread, the NIM is the function of the asset allocation. FY23, we are 78% average CD ratio. That's a ratio of against 100 rupees of deposit over advances, typically 78%. Going forward, we want to expand the NIM by increasing our CD ratio.
Right. Mr. Singh, when we look at the CASA ratio, it would be fair to say that your bank has been maintaining well above peers, but retail deposits are also growing at a healthy level. How does it translate as a benefit for you?
No, actually, when we talk about CASA, we have not only been able to maintain a good level of CASA, but otherwise also, I would like to mention here that it's a true term CASA. So on savings banks, we are paying only 3.5%. which last year, if we talk, related to a deposit cost of only 4.9%. So we are totally a retail-centric liability model or a deposit model, where going forward also we want to grow our liability franchise in a similar way. We are a branch-centric business model, and with focus on retail deposit, and in our growth journey also we'll be focusing to grow both CASA and retail deposit.
So, Mr. Jain, while majority of the portfolio is from secured loans, 84% are linked to immovable tangible assets. How would this translate into your NPAs? Do you think that you can reduce the NPA levels?
If we look into our asset quality profiling, first I just like to share a few of the practices we follow. One practice we typically follow is near zero write-offs. I'm very happy to share over the last period, which includes the COVID period, we have almost zero write-offs, and we follow a practice of no NPA sell-off policy. So with these two practices in sight, over net NPA number and gross NPA number are typically the outcome of pure recovery effort based. And given these things, if we look into our numbers and net NPA, FY23, September 24, September 23, March 22, are typically in the tight range of gross 2.7, around 2.7 to 2.8, net 1.4 and around 1.35 to 1.45. So going forward, what we believe since we are a lender for the purpose and we are a secure lender and we have a very strong streamlined credit assessment processes. Going forward, we also intend to maintain the similar asset quality as we move forward. And so we believe the money which we lent or money which we are given is recoverable. Yes, there may be a time lag available given the if account become delinquent and the actual recovery efforts.
Right, both of you, thank you so much for taking the time out and congratulations on your listing once again.